Okay, Assalamualaikum and very good evening. We are continue with the chapter 6, which is job order costing. Basically, in the management accounting, we have three techniques in the calculating of the cost per unit of the product. The first one we call as job order costing. Second one is process costing, and the third one is contract costing. But for the management accounting one, we only cover two type of the costing, which is job order costing. We are covered for the chapter 6, and for the chapter 7, which cover for the process costing. The first part is you need to differentiate what are the job order costing and the process costing. So basically for the job order costing, we have the same purpose, which is to determine cost per unit of the product, and those to determine how much the selling price that we need to quote to the product. But what is different between job order costing and the process costing? Job order costing normally we are using based on the nature of the product, that custom made product, or that one is based on special requirement by the customer. For example, we have to receive one order from the customer to bake 5 kilo cake, and the flavor of the cake, for example, is chocolate and plus cappuccino, for example. So basically the bakery, they are not display 5 kilo cake, because normally 5 kilo cake they are baked based on we get the order from the customer. So that one we call as job order costing. We are using the job order costing to calculate how much cost per unit of the product, and thus to determine how much selling price to sell for the 5 kilo cake. Okay. Second one is process costing. We go in detail for the chapter 7, but basically for the process costing, normally they are involved in the mass production. Okay, in the manufacturing company, for example, the F&N factory, they need to produce the 100 plus soft drink, for example. So that they need to use the process costing to determine how much cost per unit of the each bottle of the 100 plus, and thus determine how much selling price that they quote to the customer. Right? So you can read all the notes in my slide, what is different and similarities between job order costing. But basically in the chapter 6, you need to identify, you need to focus on the two subtopic, which is the first thing is you need to prepare the job costing statement, the first subtopic. Second one, we have the journal, how to show the flow of the job costing approach. Okay, so the first one I focus on the first subtopic in the job on this chapter, which is how to prepare job costing statement. Okay, so basically this is format for the job costing statement. Right? So the first thing is you have the first element, which is direct material. Second element you have direct labor, and the third one you have direct expenses. Direct material plus with the direct labor plus with the direct expenses, then we get the run cost. So in the direct material, you need to show in detail in the first column here the quantity times with the price, then we get the cost of the material. Okay. Same goes with the direct labor also. You need to show in clearly the hours time with the rate, then we get the direct labor cost here. So direct material and direct labor, that one is compulsory, must have in the job costing statement. But the direct expenses, example for the direct expenses is hired for the special machine. So this is not a common machine, but this one is a special machine. The purpose we are using for that particular job. Okay, so hired for the special machine, that one is under direct expenses. So then total up, we have the prime cost here. Then once we get the prime cost plus with the production overhead, we get factory or production cost. How to get production overhead here? The formula is OAR times with the actual basis. This is the same knowledge that you are covered in the chapter 5 to get budgeted overhead. Okay, the formula is OAR times with the actual basis. Then we have the production cost, then plus with the non-manufacturing cost. Example for the non-manufacturing cost is selling cost, administration cost, distribution cost. That one is a non-manufacturing cost. Production cost plus all these costs, we get the total cost here. Then total cost plus with the profit, then we get the invoice price or selling price. Okay. And this is how to calculate the profit. Basically, in the profit calculation, we have two methods to approach. The first thing we call as percentage on cost. Another one is percentage on profit margin or selling price. Alright. So how to calculate the profit based on cost? Let's say our total cost here is 10,000. And they are mentioned in the question the profit is 20% on cost. So how to calculate profit here? 20% times with the 10,000 our total cost here, then we get 2,000 profit. So then total cost 10,000 plus with the 2,000, then we get the selling price is 12,000. So this is the approach percentage on cost. And if the method to calculate profit based on percentage on profit margin or selling price, so the total cost, let's say 10,000, we have the 10,000, and profit is 20% on selling price. Okay, so means that automatically our total cost here is 80% on selling price. Okay, because our profit, you know that total cost plus the profit equal to selling price. So profit is 20% on selling price. So 100% minus 20%, we get 80%. So the total cost equation is 80% on time with the selling price equal to 10,000. Okay, so our then we are solve this equation. Selling price equal to 10,000 divided by 80%, then we get 12,500. So 12,500 is selling price. So selling price minus the total cost 10,000, 12,500 minus with 10,000, then we get the profit equal to 2,500. Okay, so this is the example for the job costing preparation. Okay, for example, you have Transmart Berhad manufacture precision tool to its customer own specification. So that one is clearly show that this is to determine cost and selling price of the product by using of job or the job costing method. Then they have to cover 3 cost center A, B and C. And then this is all the information for the cost center A, B and C. And this is budgeted production for the every cost center. And this is basis. Okay. So this information to calculate OAR for the cost center A, we are the basis is machine hour. Same with the cost center B and direct labor hours for the cost center C. Okay, next information given is all the information related with the material. That means we are request 6,780, but they are written 39.6. So the difference here, that one is usage of the material. Okay, the next information they are given is direct labor. So they have give in hours and also rate. So this is cost direct labor cost for the cost center A, B and C. And this is hired special machine, 15 ringgit. That one is the direct expenses, and this is actual basis for the machine hour. And the profit is using the first method, which is 20% on cost. And the last information that are given is all the non-manufacturing costs, which is admin and selling. Okay, so then before we are prepare job costing statement, the first step is you need to calculate the OAR first. How to calculate OAR? You have budgeted overhead just now for the cost center A, 38,500 divided by the basis 22,000 machine hour. Then we get 1 ringgit 75 cent per machine hour. Cost center B, 75,088 divided 19,760 per machine hour. Then we get 3.8 per machine hour. Same goes with the direct labor cost center C. We base on direct labor hours, we get 0.98 per direct labor hours. So this is the first step before you start preparing the job costing statement. Okay, after you calculate the OAR, then we go to the first item, which is direct material. So we have this is direct material usage, direct material requisition minus with the return to store just now. So you get 6,740.5. Second element, you have direct labor. So remember, this is every single cost center for the direct labor. You need to show directly hours times the rate. Then you will get cost of the direct labor for the each center. Okay, you need to put in the first column. Okay, total up cost center A plus with the cost center B, cost with the cost center C, direct labor, we get the total. We are transfer the second column, 2,625. Then the third element, we have direct expenses. We have 59 ringgit. Then total up all these, you have direct prime cost. Direct material plus with the direct labor plus with the direct expenses, you have prime cost 9,424.5. Okay. Then, to calculate production overhead, just now you have the OAR. So, remember the formula to get production overhead is OAR times with the actual basis. Alright. So, for the cost center A, the basis is the OAR is 1.75 per machine hour, and we take the actual machine hour 411 hours. So then we get production overhead for the cost center A is 719.25. Same goes with the cost center B. They have the basis of machine hour times by the 657 machine hour. Then we get 2,496.6. But for the cost center C, our basis is on direct labor hours. So, we take cost center C actual hours is 279 hours based on the direct labor hours here. Okay, 279 because of the basis of direct labor hour. Okay, so 279 for the cost center C, direct labor hours, actual direct labor hours, then with the OAR 0.98 direct labor hours, then we get 273.42. Then we total up all the production of it for the East Coast Center. Then we get 3,489.27. So then prime cost plus with the production overhead. Then we get production of factory cost 12,913.77. And plus with the non-manufacturing overhead. So we have admin and selling. Right? So admin and general overhead, they already mentioned 10% on the production cost. So 10% times the 12,913.77. Then we get 1291.38. Then the selling and distribution of it, they already given 2064. Then we get in total for the non-manufacturing is 3,355.38 total up. Then we get the production cost plus with the non-manufacturing of it, we get total cost 16,269.15. That one is total cost. Then the next one is total cost plus with the profit, we get the selling price. Second objective to determine how much the selling price. And we know that the profit method, we are based 20% on cost. So 20% time with the cost here, 16,269.15. Then we get the profit is 3,253.83. Then once we get the profit 3,253 plus with the total cost, automatically we get the selling price for this job is 19,522.98. So this one is how to calculate, how to prepare job costing statement for the first part. Okay. Then you can look at my slide. You can go through one by one the detailed explanation. Okay. Okay. So the second part is you need to know how to prepare the flow or the journal for the flow of cost in job order costing system. And you don't need to prepare the T account, but you just need to write down in the journal entry. Okay. The second part. Okay. So basically, this is the concept that you need to know. Okay. The first item is raw material. So we are start record the process or the journal from the we are purchase the raw material. Okay. So if you are looking in this slide, basically the raw material account, we have the once we are purchase the raw material, we just put in the debit side purchase material. Okay. And then when we are use the direct material, once we are purchased, so that's why we need to put in the credit side. So once the material purchased, we are keep in the store. Then once the production request to use the material, then we are credit side. Means that we are the material out from the store. Okay, and you need to remember all the direct material, direct labor, and manufacturing overhead apply. That one we call as we are transferred to the work in process, because this is we are start to continue process. Okay, so we not record as direct material in the journal, but we are record the amount of the direct material as work in process, right? So the second item of the material, of the raw material, we have indirect material, because indirect material we are include under manufacturing overhead, and we put in the debit side, which is actual indirect material. Okay, so indirect material we put in the T account as manufacturing overhead. Okay, so how to generalize this transaction? The first transaction, the first flow is we are purchase the raw material. Raw material purchase are recorded in inventory account. So we are debit raw material because raw material in the store. And credit side, we are record account payable. Means that if we are purchase on credit. If we are purchase on cash, we are debit raw material and credit cash. So the amount we put how much the cost material purchase. Okay. The second thing is the usage of the material. Means that once we are use the material. Alright. So remember in the material usage we are divided into direct and indirect. So the direct amount of the raw material we just put as depreciation as work in process, and we put the amount and in the debit side of the direct material. Okay, we cannot write down in the description as direct material, but we write down as work in process. Means that we are start process of the direct material. And the second item for the debit side, we have manufacturing overhead. This amount referring to the indirect material. So debit work in process, debit manufacturing overhead, and we are credit the raw material because raw material out from the store we are record as credit side. Okay, so settle the first transaction. Second is labor. Okay, so same goes in the labor. We are divided into direct labor and indirect labor. So direct labor we just put as work in process T account, and for the indirect labor we just put under manufacturing overhead, and we put under debit side for the actual cost for the indirect labor. And how to record this transaction? We are record debit work in process, but the figure on the debit side, that one is referred to the direct labor cost. And the debit side of the manufacturing overhead, the figure here for the debit side referring to the indirect labor cost. Okay, and then we are credit side salaries and wages payable. Okay, settle second item, direct labor cost. And the third one, we have the others overhead. So others overhead, for example, we have utilities in factory, we have depreciation of the machine, we have rental of the factory. That one is others overhead under manufacturing overhead. Okay, so how to record all these transactions? That one is we are include under debit side manufacturing overhead. And if the utility, for example, debit, let's say the utilities 500 ringgit. Utilities in the factory. So debit manufacturing overhead 500 ringgit and credit account payable. Okay. For example, you need to pay tax in factory. For example, 5,000. So debit manufacturing overhead and credit property tax payable. Let's say you need to pay for the insurance of the factory. Let's say 1,000 ringgit. So debit manufacturing overhead and credit prepaid insurance. So that one is for the others overhead related in the factory, right? Then for example, you have depreciation of machine. Let's say 10,000. So debit manufacturing overhead and credit accumulated depreciation. So we are not record debit depreciation, but we are include under T account of manufacturing overhead, right? Next, this is how to calculate overhead apply. Okay, or we call as OAR. Okay, the first thing you need to calculate OAR. How to get overhead apply? Same like budgeted overhead. The formula is OAR times with the actual basis, and we need to record budgeted overhead in the credit side. In the debit side is a budget, in the actual overhead just now. Okay, so then budgeted overhead or overhead apply, we are record under work in process also. So the same technique, the same formula to get manufacturing overhead apply, same like the budgeted overhead. The formula is OAR times with the actual basis. Okay, the same knowledge just now, we are prepared for the job costing statement. And then we need to record as debit side in the work in process and credit side of the manufacturing overhead. So this is how to record. Debit work in process, how much? That one is budgeted overhead, and credit side of the manufacturing overhead. Okay, so this is how to record budgeted overhead. Okay, then this is for the non-manufacturing cost. So non-manufacturing cost is all the costs incurred in process of manufacture the job, but that one is not directly related with the product. Okay, for example, you have salary for the office staff, you have salary for the auditor, so that one we call as non-manufacturing costs. They are not involved in manufacture the product. So how to record all these transaction? Because all the non-manufacturing costs we are recognized as period costs, and we need to record as normal expenses. Okay. For example, you have salaries and expenses staff in the office, let's say 5,000. So you debit salaries and expenses and credit salaries payable 5,000. For example, you have advertising expenses 1,000. So debit advertising expenses, credit account payable. Alright, so this is all the transaction journal entry related with the non-manufacturing costs. Okay, then once complete our element to determine cost per unit of the product comprised of, in the T account for the work in process, you have direct material, direct labor and overhead apply. We total up all these costs, then we get cost of goods manufactured. Okay, then we are credit the work in process and we are completed our finished good. So how to record this transaction? We are debit. Okay. Sorry. Okay, then how to record this transaction? We are hold on, yeah. Okay, then we are continue just now. Okay, transferring completed unit. So once we are complete our process, so means that we have direct material, direct labor and overhead apply. So complete our product. So then we are debited the finished good and we are credit the work in process. So this is how to record. Okay, once a job are completed and the cost of goods manufactured is transferred to the finished good from work in process. So debit finished good and credit work in process. And then once we are sold our finished good, so automatically we need to credit side the finished good and we are record as COGS, cost of goods sold. So how to record this one is debit COGS and credit finished good. And involved in the process the transaction of the sale, we are debit account receivable or cash and we are credit the sale. So basically for the transferring unit sold, you have two transactions. Once you are record the cost of goods sold, another one you are recording the sales transaction, right? So that's all. Then once after that you need to calculate whether you have under apply or over apply of overhead. So how to determine over or under apply? So same goes, you need to compare between the budgeted overhead and the actual overhead. So means that you have the T account just now. This is the same knowledge like the chapter 5. Okay, you are determine whether you have over or under. So if your actual overhead, let's say 20,000, and your budgeted overhead under credit side you have 15,000. So you are under apply because you are estimate your overhead is 15,000 and your actual overhead is 20,000. So you need to put in the credit side under apply. Okay. And for example, on the T account for the manufacturing overhead just now, debit side, remember debit side is actual overhead and credit side is overhead apply or budgeted overhead. Let's say your budgeted overhead 25,000 and your actual overhead is 20,000. So you are over apply. So you need to put on the debit side is over apply 5,000. So this is end of the record keeping under journal or the flow of the job costing process. Okay, means that you need to end up until you are determined over and under apply. Alright, that's all for the chapter 5 for the job costing. I recap back basically the two subtopic in this chapter, which is the first one, you need to know how to prepare the job costing statement. Second one is you need to know how to record as journal in the process of the flow of the job costing. Okay, until you are determined you are in the situation of over or under apply. So the rest, all the notes, the rest, all the explanation and detailed description is you can go through on my slide in the chapter 6 job costing statement. Okay, thank you very much.